Have you ever tried Domino's Pasta Pizza? It's a delightful fusion that combines the best of two culinary worlds into one delicious treat. Just like that, there are some investments that can give you the best of both the worlds. Tax saving as well as risk-free guaranteed returns. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. We have two more channels, ET Money Hindi, where you can watch all these videos in Hindi, and if you are looking for analytical and slightly advanced topics on investing, you may go and check out our channel ET Money. Returning to today's video, we are going to learn about 5 investment options that offer dual benefits of tax saving as well as risk-free returns. Most of these investments are backed by the government and hence they have negligible default risk. And apart from their low-risk nature, these investment options qualify for tax saving under the old regime of the Income Tax Act as well. So if you're looking for conservative tax saving options, these investments are for you. Now moving to our first risk-free tax saving scheme, we have Public Provident Fund. This popular government scheme needs no introduction. It's basically a retirement scheme which comes with a lock-in period of 15 years. But you may invest in it for any long-term goal. Why only retirement? In fact, by any chance, if you don't need the money at maturity, you can even extend the tenure in block of 5 years as many times as you want. You can open a PPF account with a minimum deposit of 500 rupees and a maximum of 1.5 lakh rupees in a financial year. Currently, it is offering an interest rate of 7.1%, but this interest rate is not fixed. Government reviews it on a quarterly basis and it can change. In fact, this is true for all other schemes that we are going to discuss in this video. The best part of PPS is its taxation structure. It falls under the exempt category, which means the deposits, interest earned and the maturity amount are all tax-free. You can claim a deduction of up to 1.5 lakh rupees under Section 80C on your investment in PPF in a financial year. You can also avail loans and partial withdrawals from your PPF account. For more details on this, you may watch our other videos. The links are in the description. Well, this reminds me, while we talk about investing, it is extremely important to plan for your unforeseen expenses, which can be a drain on your finances. One of the most significant risks is medical expenses. So before making any investments, you must take an adequate health insurance cover. ET Money offers a 1 crore health insurance plan to take care of your medical expenses for your whole life. It is extremely affordable and starts at only 987 rupees per month. And the best part, the premiums do not increase till your first claim. So after watching this video, make sure to check it out on the ET Money app. Coming back to the list of risk-free tax saving schemes, next in line is Sukanya Samriddhi Yojana. It is a government-backed investment scheme exclusively for girl child. You can open an SSY account for your daughter before she turns 10 years old with a minimum amount of 250 and a maximum of 1.5 lakh rupees in a financial year. The SSY account has a tenure of 21 years or until the girl child marries after the age of 18, whichever is earlier. You can also make partial withdrawals of up to 50% of the balance after she turns 18 years old for her higher education or marriage purposes. Currently, SSY is offering an interest of 8%. Now coming to the taxation part. Just like PPF, this scheme also enjoys exempt tax status. Next, we have the 5-year tax-saving bank fixed deposits. As the name suggests, it comes with a lock-in of 5 years, during which you cannot withdraw or take a loan against it. You can open a tax-saving FD account with a minimum amount of 100 rupees and up to a maximum amount of 1.5 lakh rupees in a financial year. The interest rate on tax-saving FD accounts varies from bank to bank but is usually higher than the regular bank FDs. It is currently around 6.5 to 7% per annum. Now coming to the taxation part. Investment in these FDs qualify for tax benefits under Section 80C, but the interest earned on the tax-saving fixed deposits is taxable as per your income tax slab rate. The main objective of Senior Citizen Savings Scheme is to provide an assured return to senior citizens. The interest is paid out quarterly and helps create a regular income for the retirees. A person aged 60 years or above can open an SCSS account with a minimum deposit of 1000 rupees and a maximum deposit of 30 lakh rupees in a financial year. Remember, you can deposit only once in an SCSS account, but you can open multiple accounts just like bank FDs. However, The total deposit in SESS cannot exceed 30 lakh rupees. The SESS account has a tenure of 5 years which can be extended for another 3 years. For that, you will have to submit an application within 1 year from the date of maturity. And if you need money before maturity, you can close the account prematurely, but you will be charged some penalty. So if you close your SESS account after 1 year but before 2 years of opening the account, you will be charged a penalty of 1.5% of the principal amount. And if you close your account after 2 years but before 5 years from the date of opening, you will have to pay a penalty equal to 1% of the principal amount. Currently, SESS is offering an interest at the rate of 8.2% per annum. As told earlier, is paid out quarterly. Coming to the taxation part now, investment in SESS qualifies for tax deduction under Section 80C of the income tax. So only up to 1.5 lakh rupees in a financial year will avail this tax benefit. So even if you have invested a higher sum, say 10 lakh or 20 lakh, you will be eligible to claim tax deduction of only up to 1,50,000 rupees in a year. The interest earned on SESS is taxable at the applicable slab rate. Another well-known government-backed tax saving scheme is the National Savings Certificate. You can invest a minimum of 1,000 rupees in NSCs. It has to be a one-time payment. But again, you can have as many certificates as you want. It matures after 5 years. Currently, NSCs are offering an interest of 7.7%. The interest on NSCs is compounded annually. It gets reinvested every year and is paid out only at the time of maturity. Now, as far as taxation of NSCs is concerned, the investment amount qualifies for tax benefit under Section 80C. The interest on NSC for the first 4 years gets reinvested and it can also be claimed as deduction under Section 80C. However, the interest income is taxable at the time of maturity as per your applicable tax slab rate. This wraps up this video. If you liked it, please give it a thumbs up and share it with your friends and family members as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.